Welcome to Taking Stock. I'm Amanda Lang. Coming up this week, a special look at your finances, including managing your debt so there's something left to save, the best returns on your money and making sure you have enough of it, plus doing good while making good. Ethical investing is still a thing. That's all ahead. First, a look at the state of savings and debt for Canadians by the numbers. At the end of last year, Canadian household net worth rose 1.4% to a total of $17.5 trillion, according to StatsCan. It's the fourth consecutive quarter of growth. But rising debt is also part of the story. For the first time, our collective debt exceeded $3 trillion at the end of 2024, and of that, non-mortgage debt rose 31.8% from the year before. As debt rose faster than income gains, debt-to-income levels also inched higher. At the end of last year, Canadians owed $1.73 in debt for each dollar of disposable income. And household savings took a hit at the end of the year to 6.1%, but our investments in markets was strong, with net acquisitions of mutual funds hitting $52.6 billion, a high point since 2021. Along with investing in homes, growing savings in the market is an important part of a retirement plan. The longer-term average return on the TSX was 9.3% a year between 1960 and 2020, and on U.S. equities, about 10.6% over the same period. The biggest risk to investment returns is inflation. For instance, that U.S. return of 10.6% over 60 years shrinks to 6.3% a year after inflation. How much wealth we accumulate varies, as you might expect, by age. Under 35 years have a net worth of $159,100. By 45 to 54, that's risen to $873,400. And by retirement age, $738,900 on average. Debt is a reality for most Canadians, and increasingly we're going to carry that debt into retirement. So how can we make the best plan? Bruce Sellery is CEO of Credit Canada and a personal finance author and expert. Bruce, thanks for being with us.
My pleasure.
Let's start right there. A lot of older people have debt. How big a problem is that in Canada?
It's a huge issue. The number is alarmingly high, no matter which one you look at. So the average outstanding credit card debt in Canada, $4,500. Average debt, $21,000 when you roll in the lines of credit. The total is $2.5 trillion, and debt to income is 180%. So you don't have to look to any other data points to see we've got a problem.
So what, in terms of people who are getting older, and I often think, if there's an 18-year-old watching a special in personal finance, super easy advice. Start saving now, save 5% of your income for the rest of your life. You're going to be golden. If you're 50 and you have a lot of debt, and the chances are you do, especially because of the way the housing market is now, how do you advise people who are starting to get really worried as their retirement is coming into sight, what they should be thinking about when it comes to that debt?
So there's 5 steps you need to take, and they're the exact same whether you're 18 or 65. And the first step is lay the foundation. And I think the advice I'd give to folks, over the age of 50 is look at what your priorities need to be in terms of the things you can work on. Because there's so much coming at people. Should I focus on retirement savings and taxes and all that stuff? The priority pyramid, which is one of the models we use, has you look at, is it a cash flow issue? Is it debt repayment? Is it savings? And then when you figure out where you are on that pyramid, focus ruthlessly on the actions that are going to make the biggest difference. So laying the foundations about choosing your priorities, and then, determine what you want and develop the plan. A lot of people have a lot of wishful thinking about their personal finances. Like they kind of walk through life with their hands over their ears and they're like, la, 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 largely oblivious. Very few people who've got that issue have thought through, like, what am I actually doing about that? What's that plan actually look like?
All right, and walk me through the 5. The pyramid, obviously figuring out sort of what your needs are. What else are we doing to make sure we can get our affairs in order?
So number 2, determine what you want. Number 3, develop the plan. Number 4, take action, like actually doing some things, overcoming procrastination. And number 5 is about staying engaged. I think the biggest thing that people think they do or think they want to do is around budgeting. And we've got a method that's not quite budgeting. It's called sustainable spending. Analyze, brainstorm, change. And I think this is good discipline for young Canadians, older Canadians, people at the high end of the income, people at the low end of the income, to understand what's coming in and where is it going out. That's the A. The brainstorm is, what could I do differently? How could I increase income or cut expenses? And then the C, ABC, commit to change. Make some choices, hard choices, about how you're going to alter the trajectory of your financial life.
Debt is not all created equal. We know that. There's bad debt, right, including credit card debt, which is very high interest. There's so-called good debt, like a house where you're building equity in something. It does make a difference what people have. Do you worry that more people will own less of their home as they get older just because of the way the housing market is shaping up?
Yeah, I think that for sure that is a question. I challenge you on the good versus bad paradigm, though. I don't agree. I think you've got debt that works for you and debt that doesn't work for you. And you've got people who've got a ridiculous mortgage that might fit in the good debt category, but it's actually not what works for them. It's not the right choice. So let's also remove any judgment or shame around the debt that people have, because often they will make a shortcut to, oh, I've got bad debt, I'm a bad person. You're not a bad person. You've got what you've got. Your circumstances are what they are. And let's get focused on developing a plan that's going to move you to where you want to go.
Bruce, so good to have you for this. Appreciate your time.
You're welcome.
Bruce Sellery is CEO of Credit Canada. Coming up, relatively low interest rates have made low-risk investing less appealing. So how can you grow your nest egg? Stay with us. How your assets grow over time can have a big impact on what kind of wealth you accumulate, of course. Natasha McMillan is Business Director of Everyday Banking at ratehub.ca. Natasha, thanks for being with us.
Thanks for having me.
And this is very relevant for a lot of people who are saving and investing for the future, because the less risky part of that equation hasn't been very good for a long time. Low rates mean bonds don't do as well as they do when inflation and rates are high. And even your savings, of course, do nothing. What's your advice to people in a low rate environment who are still worried about taking on the pure risk of the stock market?
So a high interest savings account is always the best place to consider, depending on your risk appetite and what we're seeing in the market today. It allows you to kind of earn more interest today, anywhere between 1% to 3.5%, in an environment that makes you feel comfortable and safe to ensure that you're kind of growing your base savings.
And of course, this low rate environment that, even though we've seen rates coming up here, they came up, of course, as we fought inflation, they're coming back down. Do you have a view of how low we get on rates as we kind of settle back into whatever the next normal level is?
Typically, what we expect and what we've seen in the past is high interest savings rates accounts and savings account rates move in lockstep with the Bank of Canada rate announcement. So as those rates continue to go down, if they do, we do anticipate savings rates dropping by roughly the same amount as well. It is a great thing to continue to do your research and ensure that you're looking for the best rates out there, because some banks do offer a better rate than others. And so ensuring that you're finding that best rate and maximizing your savings is critical.
Do you feel as though Canadians shop around as much as they should for these kinds of things, even bank to bank, or do we get kind of sticky with our existing bank?
I'd love to say that we are those that shop around, but even speaking for myself, we tend to stick to what we know, typically the bricks and mortars and the banks that we have worked with for a longer period of time. I think we are starting to see that shift in our population, that we are more focused on what is the best product for us for our goal. And that is something that has evolved over time, but we are still behind what we would anticipate where we should be.
And of course, inflation is one of the most pernicious things that can happen to people in terms of eroding savings and their overall wealth. Is it your expectation that inflation is behind us? Obviously, we have this massive issue of tariffs that's creating a lot of uncertainty for people. We don't quite know which direction that all goes. But how big a factor is inflation for people who are trying to save?
I think inflation is always a worry for individuals who are looking to save. And in times like where we are uncertain about what's happening in the market, uncertain about kind of entering into a recession, it's even more important to look at setting yourself up for financial success. So that can mean paying off any debt that you may have, and even looking to add the extra few dollars to a savings fund, an emergency fund, or anything like that will actually get you ahead in the long term and ensure that you're set up for success.
Do you have thoughts on advice about the size of those funds, what people should have in their emergency funds, what they should have in savings, as people are trying to figure out how much to set aside from their operating costs?
Typically, they say anywhere between 3 to 6 months is what is recommended. Of course, if you can get well above that on your run rate, that's even better and kind of helps you out in the long run. That does tend to be, depending on the burn rate of any family, can get to be extensive. So it is always important to put as much as possible into those funds for that rainy day should it come.
Natasha, so good to have you for this. Appreciate your time.
Thank you so much.
Natasha McMillan is Business Director of Everyday Banking at ratehub.ca. Part of the problem with planning well for retirement is having a real grasp of what you need. Fortunately, there are some tricks to figuring that out. Fred Batiste is an author and retirement expert, former chief actuary of Morneau Chappell. Fred, great to have you with us.
Hi there.
So I want to start with whether you think most people are prepared. When I look at the data on kind of the average that we have at retirement, it feels like not enough. Where do you think most people stand?
No, that's kind of interesting. Morneau Chappell, when I was there about 15 years ago, we actually did a survey of our clients, and we got responses from over 100 of them. 70% of them thought there was a retirement crisis. Then Bill Morneau and I produced a book about this, showing that there was no crisis. And 2 years later, we did the same survey again, and 70% still thought there was a crisis. So we didn't change anyone's mind. So people have thought of this for many, many years, that there is a retirement crisis in Canada, but it never seems to materialize. But I would say for the average viewer, the more important question is whether they themselves think that they're prepared. And you know what? As long as you're saving 10% a year, I don't really think people are going to have a problem.
And of course, that number would change depending on when you start. If we were all lucky enough to start at 18, it's a much lower number in terms of what you got to put away.
You have to start at 18. I think if you start at 30,
okay,
and you save consistently at 10% until your 60s, you're going to be fine.
And so I do want to ask you about people that start late, because there are some people who, for whatever reason, especially now, maybe because they're saving for big assets like a home, they haven't really started until they're into their 40s. Does that change the formula on what we need to put away?
It changes the formula for sure, but it still is quite doable. In fact, I kind of covered this in my book called The Rule of 30. And what I showed was, in fact, I said most people in their 30s, they really can't save that much because they have a mortgage, they got daycare to worry about, they have other expenses that happens in early life. Early family life. Mm-hmm. So they just can't save that much. And so they shouldn't sweat it. They ought to be thinking about maybe saving 5% in their 30s, 15% in their 40s, and then maybe more like 20 or 25% in their 50s. And while that sounds like it may not be doable, the fact is by the time you're in your late 50s, the mortgage is probably paid off on the house, and maybe the kids have finally left the home as well. And so you actually have a lot more disposable income anyway.
That's one thing I wanted to ask you about, is whether these calculations change if people don't own their home. We're seeing longer amortizations. We're seeing bigger first, home price in the first place. Will it be a different calculation for people who are a little bit younger, who may not own their home by the time they retire?
I would say the answer is yeah. They would probably be a little bit different. They ought to be saving a bit more in that case, because the way I look at it is that saving is saving. It doesn't matter whether or not you're putting the money toward a mortgage or you're putting the money into your retirement account. Both ways you're saving for your older age, really. So if you're not saving toward a home and you're only paying rent, then probably, yes, you probably do have to save a couple of % more of your pay every year.
When we look at the supports for older people, there's CPP, if you've paid into it. There's OAS, which is often talked about as something that should be increased by various politicians over time. Are there plenty of supports for people who may have less privately saved or in a pension, but that would rely on the government?
Well, I guess the good news is that both those programs have been improved over the past 10 years. Bill Morneau, when he was finance minister, got the other finance ministers together to expand the Canada Pension Plan. And while it will take a while to totally phase in, as a result of it, it means that rather than getting 25% of salary from the Canada Pension Plan, the ultimate percentage will be more like 33%. So that's one improvement. The other improvement was the government a few years ago expanded the old age security program so that people, once they reach age 75, get another 10% boost in their OAS payments. So overall, the government's actually provided, I would say, quite sufficient help for people in their who are saving for retirement.
And based on your research of our own savings, what's the rule about what we should expect to withdraw every year? When we look at our pile of cash, is there a percentage we know we can count on to take out every year so that we know it'll last us?
I covered that actually very recently in the Globe and Mail article and I talked about the rule of 40, which sorry, the rule of four, the 4% rule, which I've always found a little bit suspect. This was first devised back in the 1990s. 4% rule says, let's say your savings were, just to make the math really simple, $1 million. 4% rule says in the first year you can withdraw $40,000. Second year you withdraw the 40,000 plus inflation, and so on until the rest of your life. So I actually tested that rule, and I found that the 4% rule, if anything, has been conservative since about 1950. I didn't test before 1950, by the way, but it has been conservative. And so the 4% rule has always been sustainable. In fact, it could have been as much as a 7.5% rule under in certain eras in the past. But I would say rather than rely on a rule, if you've got multiple hundreds of thousands of dollars in savings, you ought to be using more science as opposed to simply rule of thumb that you can remember in the back of your head. And we have excellent retirement calculators out there, and those ought to be used. And obviously, financial advisors are using calculators as well. And you ought to use those to figure out how much money you can withdraw.
Very good advice, Fred. So good to have you with us. Appreciate your time.
My pleasure. Thank you.
Fred Vitesse is an author and retirement expert, former chief actuary of Borno Chappelle. Coming up, a lot of investors want to do good but still make money. We'll talk about the options after this. Seeing growth is usually the top priority for investors, but for many, investing in ways that line up with their values is also key. Tim Nash is founder of Good Investing Financial Planners. Tim, and this has been your focus. Thanks for being with us.
Thanks so much for having me, Amanda.
And so I guess I wanted to start with when people think about this, does their feelings about it change based on how well they're doing? Is this a nice to add on, or is it core to a lot of people's planning?
You know, it's really interesting. So many people come to the conversation assuming that there's going to be sort of a financial trade-off, that you somehow have to sacrifice returns to invest according to your values, but you really don't have to. So people who have dug into it a little bit more really recognize that this is sort of a core part of their investment approach and is really about building confidence. We all want to believe in what we own. And so it really helps people sort of stay the course over the long term.
And that's a really important point. You're not limited to a tiny little corner of the universe here. You can access all kinds of parts of the stock market. How broad can we get? If somebody's investing their money with you, are they not investing in coal companies, or are there some coal companies that are better than others?
Well, everyone's got a different set of values. So it's important to understand that there are a wide spectrum of options available. Everyone's got their own definition of responsible. So if you want some coal companies, fine. If you don't want them at all, that's okay too. That there are a wide range of options. Certainly as we go a little bit further down the spectrum, a little bit more on the crunchy granola side of sustainable investing, that's where we can start to see some trade-offs in terms of diversification. But really, diversification is a core value. Really, what we're trying to do is own the entire global stock market, earn the same rates of return as you would otherwise, but just get sort of the nastiest things out of your portfolio and maybe use your voice as a shareholder to be able to nudge companies in the right direction.
It's been interesting because we have seen a kind of a shift in emphasis on even sustainability, certainly on things like DEI. This is more political, I think, than values-based. Have investors changed their thinking about it, or is this just the kind of the winds of politics that are blowing through these things? Kind of an interesting period during 2020 and 2021 where everyone was asking me about ESG, was the big acronym there, environmental, social governance, kind of took things by storm. And we saw lots of new products and lots of interest. And I saw so many people try to sort of enter the field and get into this space. What I would say now is that the ESG tourists are gone. The people who are just doing it to sort of catch a trend or maybe doing it for other reasons, they're gone now that the pendulum has swung back. There has been a big backlash against it, but it's really left people who really care about these issues, who are passionate, who understand it a little bit more. A lot of us in the industry kind of saw a lot of people come and then leave, and that's okay. I think that greenwashing was a really big concern for a lot of people. So
in my mind, it's almost better that, a lot of the funds that were greenwashing have closed and that we have seen some consolidation. So although there might be fewer options available than there were 6 months or a year ago, I think we've got better options now than there were then.
And of course, people like you who've been doing it a long time have a methodology that you can show a track record. How important is that to people that are new to this space, that they want to see the history of that you've been measuring this for a while?
Yeah, I've been doing this for almost 2 decades now of following this. And again, there is this misconception out there that you have to sacrifice returns, and it's just wrong. It's not there. When I show the charts of the broad-based socially responsible funds, we see the returns are almost identical. The lines on the chart are just so parallel. You can earn almost identical returns, but it does give people, I think, some confidence knowing that there is a track record. Nobody wants to do something new or scary with their money. We love the tried and tested approaches. So now that we've got track records of a decade plus, and I can really show definitively that you don't need to sacrifice financial returns, no doubt that does help to build confidence.
Tim, so good to have you. Appreciate your time today.
Always happy to be here.
Tim Nash is the founder of Good Investing Financial Planners. Time for the takeaway, and you're on your own, kid. In time gone by, Canadian workers could count on a corporate pension to see them through their golden years. And while pension membership is still reasonably stable, it is still the domain of a minority of Canadians. There were just shy of 7 million of us in an active pension by the end of 2023. Those pensions are quite evenly split between the private and public sectors at 3.2 million and 3.7 million each. What that all adds up to is that 2/3 of working Canadians don't have any kind of workplace pension. While they may receive benefits from the Canada Pension Plan, assuming they paid into it, or old age security, neither is designed to be the primary source of income for an elderly person. So what about all of those Canadians who are marching toward retirement without sufficient funds? Some of them have saved on their own, but data show that at retirement age, the average balance is $129,000, not nearly enough to generate income to support someone for another 20 or 30 years if they're lucky enough to live that long. The obvious answer to this problem is to save more, and the even more obvious and about as useful piece of advice is to start young. The math is pretty compelling that if you start saving for retirement at 18, you can get away with saving a much smaller portion of your income over time because it has a chance to grow. That's not the most useful advice for a 40 or 50-year-old contemplating a grim future. Prioritizing that future self is really the best answer in that case in order to maximize any potential savings. There are a few good strategies for doing that, and probably the best is to save before you do anything else. Deduct your savings at source where possible so you never count the money as yours to use today. And if that feels hard, remember you are sharing with yourself. If your current self wants a restaurant meal, buy one for your future you too, and commit to putting that amount of money away. My takeaway? A lot of us hate to think about our post-work savings need because it seems like an uphill battle. But hoping the future will sort itself out, but doing nothing to help it along is not a very good strategy. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.